In 2026, the IRS has become more aggressive than ever, especially in two key areas. Here's exactly what changed and the technical breakdown you need to understand the new 2026 tax landscape, IRS AI, audits, and digital tracking. The IRS is no longer relying on what you report. In 2026, every bank, every crypto exchange, and every payment app is already connected directly to the IRS. So here's the real question. If they already see everything, do you still believe you're in control of your taxes, or just one mismatch away from an automatic audit? What do you think? I read your comments. What do you think? I read your comments. This is not the IRS you knew a few years ago. We are now entering a fully digital tax enforcement era, where tax returns are no longer reviewed only by humans, but first processed by automated risk detection systems. Every return is now analyzed before a human ever sees it. And the goal is simple. Detect inconsistencies instantly. IRS AI/risk scoring explained. IRS uses advanced data matching systems, AI-driven risk modeling, to assign a risk profile to every tax return. The system compares W-2 income, 1099 forms, bank reporting, crypto transactions, payment apps like PayPal, Venmo, Cash App. If anything doesn't align, the return is flagged automatically, not for immediate punishment, but for review prioritization, meaning high-risk returns go to the front of the audit queue. Standard deduction, 2026 explained. Now let's talk about one of the most important numbers in the entire system, the standard deduction. This is the amount you can subtract from your income before taxes are calculated for 2026 based on inflation adjustments. Single filers, approximately $15,000 to $15,300. Married filing jointly, approximately $30,000 to $30,600. These numbers matter because they determine whether most people take the standard deduction or itemize expenses instead. And for the majority of taxpayers, the standard deduction is still the default path, the death of paper filing. Now here's something most people underestimate. In 2026, filing taxes on papers is becoming a serious disadvantage. The IRS has been aggressively shifting toward full electronic filing, e-file system. Paper returns are manually processed, slower to verify, more prone to delays, and often reviewed later than digital filings, which means something important. Paper filings don't get priority processing. In fact, they often enter a backlog system that can take weeks or even months. And in a system driven by automation, anything slow becomes higher risk by default. What this means for taxpayers. So let's put this all together. In 2026, the IRS system is built around three principles. 1. Digital data matching. 2. Automated risk scoring. 3. Fast electronic processing. This means inaccurate reporting is detected faster. Missing data is flagged automatically, paper filings are delayed, and mismatches are no longer invisible. The system doesn't need to suspect anything. It just compares data. Anything slow becomes higher risk by default. Now that you understand how the system works, we're going to break down the real part that matters, the mistakes people are making right now that are triggering all this without them even realizing it. We'll go step by step through income mismatches, crypto reporting errors, deduction red flags, and filing status mistakes. Because in this new system, it's not about how much you earn. It's about how accurately everything matches across the entire system. Let's get into it. Income in the new 1099 forms. Now let's move into one of the most critical areas in the 2026 tax system. Income reporting and the new generation of 1099 forms. Deep dive. Form 1099K in 2026. The $600 reporting threshold is fully in effect, and it is now directly connected to platforms like Venmo, PayPal, and Cash App. This is where confusion becomes dangerous, because not all money you receive is taxable, but the IRS doesn't automatically know the difference. You must clearly separate what is a personal gift, a reimbursement from friends, and a payment for goods or services. Because once a 1099K is issued, that transaction enters the IRS system as potential income. And if your tax return doesn't reflect it correctly, the system will detect the mismatch. Form 1099-DA, digital assets, the game changer. This is the topic of the year, and this is where everything changes. For the first time, the IRS now receives automatic digital reports for crypto and NFT transactions. Form 1099-DA, the digital informant. Starting this tax year, the IRS has implemented Form 1099-DA for digital assets. Here's how it works. Before, you were responsible for tracking every crypto purchase and sale yourself. Now, digital asset brokers, including platforms like Coinbase, Kraken, Gemini, and even NFT marketplaces like OpenSea, are required to report this information directly, or what information is reported. The report includes the date you acquired the asset, the date you sold it, your cost basis, what you originally paid, and the gross proceeds from the sale. Data matching system. And here's the critical part. A copy of this report goes to you, and another copy goes directly to the IRS. So if you fail to report that transaction on your tax return, the IRS system will automatically detect the discrepancy. And once that happens, you're no longer invisible in the system. NFTs are no longer invisible art. Now let's talk about NFTs, because in 2026, they're no longer invisible to the IRS. In the past, NFTs existed in a gray area, but that era is over. Today, the IRS generally classifies NFTs as either collectibles or digital assets, depending on how they are used. Trades are now taxable events. Here's where most people get it wrong. If you traded an NFT for Ethereum, the IRS treats that as if you sold the NFT at fair market value, and then use that money to buy Ethereum. That means one thing. You just triggered a capital gain or loss, and it must be reported. Reporting platforms are expanding. Now let's talk about how the IRS is tracking all of this. For custodial wallets, where the platform controls your private keys, automatic reporting is already happening. Platforms are generating reports and sharing that data directly. But what about cold wallets? Devices like Ledger or Trezor. This is where things get more advanced. The IRS is now using blockchain analysis tools to trace transactions and connect wallets to real-world exit points, known as off-ramps, where crypto is converted into cash and enters the banking system. And once that connection is made, you're no longer anonymous. The Crypto Trap plus Deduction Strategies 3, the Crypto to Crypto Trap. Here's one of the biggest misconceptions in crypto taxes. Most people believe they only owe taxes when they cash out into dollars. That is no longer true. The 2026 rule, swapping Bitcoin for Solana, is a taxable event. It doesn't matter if no money ever touched your bank account. The IRS treats that transaction as a sale at a fair market value in US dollars at that exact moment. Automatic reporting. And here's where it gets serious. When that trade happens inside an exchange, the platform records the dollar value of both assets and reports it through Form 1099-DA. So even if you never think about it again, the system already has the record. Foreign income, FBAR and FATCA. Now, for those who travel or have accounts outside the United States, this is critical. If you hold foreign bank accounts or financial assets, you may be subject to FBAR and FATCA reporting requirements. These are not optional disclosures, and failing to report them can trigger significant penalties. Bulletproof deduction strategies. This is where smart taxpayers start to save real money. The home office loophole. Let's break down the difference between the simplified method and the actual expense method. 1. The simplified method, safe harbor. This is the no headache option. The IRS allows you to deduct a fixed amount based only on the size of your home office. The rule: you can deduct $5 per square foot of your home office space. The limit: the maximum allowed area is 300 square feet. Maximum deduction: that means a maximum deduction of $1,500. Who should use it? This method works best for people renting small apartments, those who don't want to track utility bills, internet, or repairs all year, and anyone with a small office space and relatively low housing expenses. -2, the actual expense method. This is the detailed method, where you track every dollar spent on your home and then apply a business use percentage. The process. Here's how it works. Step 1. You measure the total size of your home. For example, 2,000 square feet. Step 2. You measure your home office space. Let's say 200 square feet. Step 3. You calculate your business use percentage. In this case, that would be 10% of what you can deduct. Now you apply that percentage to your total home expenses. That includes mortgage interest or rent, utilities, electricity, gas, water, trash, home insurance, general repairs. If you fix the roof, you can deduct 10% of that cost. And if you own the home, you can also deduct depreciation. Who should use this method? This method works best for people paying high rent, especially in cities like New York or California, homes with high utility costs, and anyone whose calculated percentage adds up to more than the $1,500 limit under the simplified method. The golden rule: exclusive and regular use. To qualify for either method, you must meet one critical requirement: exclusive and regular use. Exclusive use: if you work at your dining table, where you also eat, you cannot claim a home office deduction. The space must be used for business only. Regular use, and it must be consistent. If you only use that desk once a month, that does not qualify. This is not occasional use. It must be part of your regular business activity. Example: let's make this simple. Imagine you have a home office of 200 square feet. With the simplified method, your deduction is fixed at $1,000. But if you live in an expensive city, 10% of your rent and utilities adds up to $2,500. You will be losing $1,500 in deductions if you don't use the actual expense method. And that can be the difference between paying taxes or getting a refund. IRS warning: the home office deduction is one of the most closely reviewed areas by the IRS. If you use the actual expense method, you must keep records, PDFs or photos, of every utility bill and every rent payment for the entire 2025 tax year. With the simplified method, the audit risk is lower because it does not require detailed proof of home-related expenses. With the simplified method, the audit risk is lower because it does not require detailed proof of home-related expenses. So now you understand, this is not just about saving money, it's about doing it correctly. Because in today's system, the IRS is not guessing anymore. They're verifying. And if your numbers don't match your reality, that's when problems begin. But here's what most people still don't know. There are even more powerful deductions and advanced strategies that can legally reduce what you owe without increasing your risk. And that's exactly what we are breaking down in the next video. If you want to stay ahead and make smarter financial decisions, make sure you subscribe right now so you don't miss what's coming next. Hit the like button so this information reaches more people who actually need it. And share this with someone who is filing taxes this year, because one smart move can make a real difference. And stay ready, because the next video is going to show you deductions most people completely miss. I'll see you in the next video.